Welcome to Retirement GPS, navigated by Synergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to the Retirement GPS podcast. I'm Ryan Zaharchek, certified financial planner and founder of Synergy Retirement Planning.
And I am Zane Belsack, associate planner here at Synergy.
Today, we're going to be talking about living off of the retirement that you've worked so hard to save. And this is a huge topic because, to be honest with you, other than investments, this is probably the second most important topic on the minds of people when they come to sit down with us is how do I turn all this money that I've saved in a 401k or an IRA into a life, into a stream of income. So how much can you take from which accounts? What makes sense? How do I plan my retirement? Before we get into that, as we're recording this, we're a few days from our big Synergy member dinner. It's our get-together to meet our members, make sure that we get a chance to just break bread with them and really have a good time, but also show them the things that we're working on to improve our services and improve their lives. We also have a great value add going out in the next couple of weeks. The value add is really designed specifically towards what we're talking about here, which is tax diversification. A value add is something that we send out 4 times a year to our members, specifically related to them and their unique situation. It could be something related to taxes. It could be related to estate planning. In this case, it's related to tax diversification of their investments. So how much money is in Roth, how much money is in pre-tax, how much money is in post-tax accounts. And that way, we'll have a good sense of where they should be for distribution rates later. And we'll talk about that here. And on top of that, we just finished our big surge, which is September, where we pretty much meet with every single person that we work with. We spend a lot of time talking about taxes, tax strategies, and estate planning. So let's get started on our topic today, which is living off investments in retirement. So let me start with a story. I want to give you the story of, we'll call them Sam and Lila. Sam and Lila retired with, like most people, they had 3 buckets of money that they were going to live off of during retirement. So the first bucket is what's called the taxable investments or taxable accounts. That's your checking, your savings, a taxable investment account that is growing invested, but it's not an IRA, it's not a Roth, it's not a 401k. It is taxable, which means interest and dividends are taxable as they're paid. The second is a traditional IRA, the second bucket. So their 401ks, their pre-tax IRAs, money that was saved pre-tax, tax-deferred, has been growing tax-deferred and now is rolled over into an IRA so that they're ready to live off of it in retirement. And then the last, which is our favorite, is the Roth IRA. The Roth IRA means the taxes were prepaid, so the total value of the account is not going to be taxed ever, whether you use it or you leave it to your heirs. So they had these great 3 buckets. And of course, they had other income sources. They had Social Security, which they were going to start a couple of years down the line, and then a small pension. And they wanted to keep their taxes low. So in the first couple of years, they pulled mostly from their Roth IRA. Right? This is before they came to work with us. They were retired and they were pulling from their Roth IRA. And they thought it was great. They felt like it was the smart move because they had nothing. They had no tax bill. Everything was inexpensive from the standpoint of their Medicare premiums were the lowest they could be. And they had no taxes on any capital gains in their taxable investment account. And things were humming along great. But what happened was the traditional IRA kept growing and it just kept larger and larger. And they started to run out of money out of the Roth, and they had to go to the traditional IRA to take their distributions. And at age 73, they hit what's called required minimum distributions. There is a certain amount of money that the government tells you have to take once you turn age 73 from your pre-tax IRAs, your traditional IRA or 401k, if you have not yet taken it. And that is a calculation of the balance of that account on December 31st of the prior year. And that's the amount of money you need to take out that year. And each year, as you age, the dollar amounts become typically larger and larger because the percentage is larger. And if you're investing the account properly, the account is growing. So this can become problematic because what it does is it forces you and it forced Sam and Lila into a higher tax bracket, and worse, other things were affected, such as their Medicare premiums and their taxes on their capital gains.
And I think what Sam and Lila were doing, it's not necessarily wrong, pulling money mostly from the Roth, but the problem that we start to see is you run out of your Roth bucket, and now you're forced to take those RMDs that Ryan was talking about, basically just move them from your IRA to your taxable, and then pay the taxes on it once again. So it's really just you're filling up one bucket while also depleting another one, and you get an overflow of water in your buckets.
And that can really be a problem, not only the RMD, if you have to take money, specifically though, if you have to take money that you don't need. And we do have that problem as well, where people will hit 73. And it's not 73 so much as the problem, because at 73, you're only really required to take about 4.5% of that IRA. So if you have $1 million IRA, that's about $45,000. That's not really a problem for anybody. But if you have a $2 or $3 million IRA as it continues to grow, and now you're 75, 80, in fact, we have people we work with in their late 80s and early 90s that have to take 15, 20% of that IRA. And a large IRA can create hundreds of thousands of dollars of income that you just absolutely do not need at that age.
I'll take it. I think that's a good problem to have. It's a problem. If I were retired, I would love to have that quote unquote issue of having too much money, but it's really just what order do you take it out?
A lot of the problems that we deal with here in our business are good problems to have type of problems. What do they call those? First world problems. But in our case, that's our job. Our job is to create efficiency and create as much efficiency as possible so that we're not making a mistake doing something that we think is right now, but creating inadvertent problems down the road. So ultimately, let's wrap up Sam and Lila. Essentially, what we had to do was we had to do some pretty aggressive Roth conversions, which put them into high Medicare IRMAAs for a couple of years, but it replenished that Roth bucket. And then it gave us the ability to create some tax diversification in our distribution. So we weren't distributing all from one or all from another. We were distributing within tax brackets that we were comfortable with, keeping ourselves under thresholds for other incidental expenses or taxes, and did that over a period of time that weren't going to hurt them too much. So making a mistake early on in your retirement and where you draw from can be a problem.
And Ryan, I'm going to stop you right there because I heard a couple of words that I think we should go over with our listeners. So something I heard was Medicare IRMAAs, and an IRMAA is, I think, something you should touch up upon because it's something that I think people typically don't really know much about.
It's a great question. It's something that we're going to be talking a lot about when we talk about distribution rates, because it is something that we are very conscious of and concerned about. When you collect Medicare, which every single person on this podcast is entitled to when they turn 65, again, as long as you paid into the Social Security system, as long as you worked for 4 quarters for 10 years, so you need 40 quarters, you are eligible now for Medicare. Medicare has multiple parts to it, and I don't want to get into the details of Medicare for this podcast purposes, but Part B is a sort of maintenance care of Medicare. So if you were to go to the doctor when you're sick, Medicare covers that on Part B. Medicare Part B and Part D, which is your drug program, both have premiums attached to them. Okay, and what Medicare expects is that you're going to pay a premium on that. And the premium is not terribly high, especially for people who earn below $212,000 as a married couple or $106,000 as single. But there's what's called an IRMAA adjustment. IRMAA stands for Income-Related Monthly Adjusted Amount. We just say IRMAA just because it's much easier for us to understand. But of course, it's a buzzword that most people don't understand.
Sounds cooler too.
It sounds cooler, yeah, without question. And
instead of saying the whole amount.
Anytime we can sound cool as a financial planner, we want to do it. And what happens is your Medicare premiums actually increase if your income is higher. So a married couple making over $212,000 in adjusted gross income, it's actually modified adjusted gross income. And I'm not going to get into the details of that, but you're going to have an extra $74 a month in premium in what's called the IRMAA on your Medicare premiums for Part B. And that can go up at various brackets, just like the tax bracket. If you make over certain thresholds, your IRMAA is going to go higher and higher to as much as an additional $628.90 a month if you make over $500,000 a year. So controlling how much income we earn in a year, at least for IRS purposes, is extremely important in retirement planning because it affects this IRMAA, this adjustment to our Medicare premiums. Does that make sense, Zane?
It does. It seems like it's really just an additional cost. It's something that is added on to your Medicare for those listening.
Yeah, for sure. And they're basically Medicare is not something that is flat for everybody no matter how much money you make. There is a cost and there's an increasing cost if you make more. The more you make, the more you pay. And we want to try to manage that. We want to manage that in addition to your tax brackets as well. Because again, more money you earn, if you were to earn $300,000 this year, not only would you be in a much higher tax bracket, but you'd also be in a much higher IRMAA bracket. There's other ancillary taxes, which we'll talk about as well, that you would also be responsible for if you were to earn that kind of income during retirement. So let's talk a little bit about how this all plays together. I'm about to retire and I want to start thinking about how much money do I need in retirement and where does it come from and how does all this work, right? The first thing that we always tell people is sit down, don't worry about expenses to start. Let's focus on guaranteed income sources. So the first thing that we want to look at are things like Social Security. First of all, are you going to collect Social Security when you retire? Now, if I retire at age 55, I'm not even eligible for Social Security yet. So the answer is no. Or when I retire at age 65, I am eligible for Social Security most likely as long as I've worked and my 40 quarters of credits. But do I want to collect it at age 65 or age 67, which is my full retirement age, or even age 70 where I'm going to get the maximum benefit? So we need to think through these things. When am I going to collect Social Security and how much? Now, when do I collect Social Security is really a podcast topic for another time. We're not going to talk about that here, but let's just assume that you're going to collect Social Security when you retire and you're going to get your benefit. And let's assume you're going to have some other stream of guaranteed income. Maybe that's a pension, maybe that's an annuity that you've invested in or saved in and you've got an income source that's guaranteed. Now you don't need that in order to retire comfortably, but the purpose of this example, we just want to show that yes, we're going to have Social Security and we're going to have a small pension. All right. Maybe I'm earning $3,000 a month for my Social Security. My spouse is earning $1,500. So now we're at 45. And then I have another $1,000 a month pension. Now I'm at $5,500 a month. Okay. That's great. We call that your guaranteed income source. And that allows us to set the base of where we are. Now, one other thing to consider, which has to be important and has to be thought about is, are those income sources adjusted to inflation? Because $5,500 today for the rest of my life may feel great, but in 20 years, when my property taxes are $40,000 or $50,000 or even $60,000, will that be enough? And we know the answer, because if you look at what your property taxes were 20 years ago, I can promise you they're going to be 2 to 3 times higher 20, 30 years down the line. And we do want to plan that we're going to be alive for that long in retirement.
And we've talked about this in previous episodes. I noticed that this is a reoccurring, I want to say, theme and or problem. You take something like a movie ticket 20 years ago, it was, I think Ryan can shed some more light on that, but I think now it's, what is it, about like $20 per ticket? It's crazy.
Yeah, for sure. I think probably 20 years ago, you're probably paying $7 or $8 for a movie. Let's just say you're paying 16, you're looking at a double, right? And I don't think that's too surprising that to anybody who's been on this earth for more than 30 years, that costs go up over time. They just do. So we need to account for that. If you have inflation adjustment on your Social Security, great. We can kind of lock that in. But if your pension does not, and a lot of pensions don't these days, we just need to make sure that we're accounting for that and knowing that pension value is going to be falling as time goes on. So once we have our guaranteed income sources, now what we're going to do is we're going to sit down and lay out our expenses. What do we expect our expenses to be? And we want to look at everything. So most people, when we say, what are your expenses? They give us their bills. Zane, I mean, you've got experience with this.
Yes, I do. Yes, I definitely do. And we've talked about this in it was our goal setting episode, to annualize your expenses to get that more accurate number.
Annualization is really the right way to think about it, because anybody can think on a monthly basis that my electric bill is $150 a month on average. But what is really hard to think about is, what is my holiday spending every month on average, right? What do I spend at Christmas or for birthdays on average on a monthly basis? What we need to do, if we look at that annually, it's much easier. What about vacations on a monthly basis? It's really hard. But when we look at vacations on an annual basis, much easier to come up with a number. So use annual numbers. Write down everything that you spend money on in the past year. If you have a credit card bill, pull that out. If you pull out your checking account, it's typically you can go through the last few months. Pretty good way of coming up with the data. A few things that people miss when they're typically doing this exercise, just to make you aware of. We did talk about a few already. One is holidays. What do you gift at the holidays? And that could be any holiday throughout the year. What if you have a wedding to go to? What if you have a birthday to go to? What are you going to give as a gift? And that's got to come from somewhere, right? Most people say, well, I can't possibly anticipate that. You can't, but we can have a rough number that I give roughly $1,000 a year in gifts. Just making sure that we have a number associated with that. And maybe 1,000 is not right for you. Maybe it's a lot less. Maybe it's a lot more. Come up with a number that's right for you.
One that people typically miss out on is auto repairs. And when I talk about that, a good question is to say, what month do you think your car is going to need repairs? And the answer to that is, I have no idea. And I would say most people don't have any idea. They have some kind of guess, but it's better to annualize that and take what you spend on your car year to year rather than in the month of June or the month of September. It's a lot easier to put that on a year-to-year basis.
And what we encourage our people to do is come up with an annual number. And the annual number is going to be wrong. I can tell you right now. It's never going to be exact, but try to think about the average of the last 4 years. What did you spend on your car? I know I get new tires probably every 2 to 3 years. I get new brakes every 2 to 3 years. And then you start to take that stuff and you average it out over time. And on average, I think my budget in my household about $3,000 a year for car repairs and car maintenance. And we're not off. Some years are maybe $1,500 and other years are maybe $4,000, but that's pretty close over time because in some years we have bigger repairs than others. It's not about being perfect. It's about getting as close as possible and then adjusting each year in and year out. Vacations is another one that we did talk about. Make sure that you're accounting for vacations and what you spend on those over a period of time. So irregular expenses should be accounted for, but come up with what is it that I spend on an annual basis? What is my living expenses? A lot of people come to us and say, hey, should I give you a full budget? Should I give you a full inventory of what we spend each year? And the answer is, yeah, you can do that. That's fine. That's great. We actually like that because we can find potential problems in there that we can clean up. But if you don't want to do that because that's not your personality or not that detail oriented, just come up with a bottom line number. We know we spend $100,000 a year, we spend $80,000 a year, we spend $200,000 a year. Whatever your number is, come up with a bottom line number that you're going to spend. And that gives us a really clear indication of how much money do we need to put in your pocket to make that work. So let's use easy numbers. And let's just say you're going to get $5,500 a month, which we know we've already talked about, in your guaranteed income sources, but you need $120,000 a year. Right? And if you do the math, $120,000 a year is $10,000 a month. Now, again, based on what we talked about in irregular expenses, you shouldn't be spending $10,000 every single month. Some months will be a lot less. Some months will be a lot more because those irregular expenses will come up. But that's okay. We know it's going to be roughly $10,000 a month. So if it's $10,000 a month and we are getting $5,500 in guaranteed income sources, of course. And by the way, that $5,500 is after taxes. We've already accounted for taxes, so that's going into our pocket. Now we've got to make up the difference, and the difference on the $10,000 is $4,500 a month. We need $4,500 a month after taxes in order to ensure that we have a comfortable lifestyle in retirement. We also need to make sure that dollar amount is going to go up each year. Let's not worry about that for now, but we'll focus for the time being on filling that $4,500 gap. So the next question is, where does that money come from? And is that too much money? So let's talk about distribution rates next. Let's just say I want to draw $4,500 a month every single month. I know I need $54,000 per year in order to comfortably live and pull from my investment accounts. That's $54,000 after taxes, right? Some of the accounts that we have are probably going to be taxable and some are not. So what we need to do is take a look at what are the accounts that we have, total value of those accounts, and what percentage are we drawing from. So if we need to draw $54,000 from our account, and all of our accounts are after-tax accounts, and let's say that there's no tax liability associated with those, we can basically pull that money and not have to pay taxes on them, which is great. That would be the dream. Now, it's not always going to be the case, but that would be fantastic. We want to make sure that we're drawing anywhere from roughly 4 to 5% from those investment accounts. Okay, we don't want to draw more than 5%. If you draw more than 5% over a long period of time, you run a very high probability of drawing through your investment accounts and effectively running out of money. And running out of money does not sound fun.
No, it does not. It sounds a lot like a guardrail strategy. If you go over 5%, then you run the risk of losing all your money. But if you go under 4%, then you end up in situations where you have to take a huge RMD amount.
It depends. If you draw less than 4% from a pre-tax account, that would be the case. But if you drew less than 4% from a Roth IRA, that's fine. Going under 4% is not really a financial problem. It's just you're not potentially spending as much money as you could in retirement. And we have plenty of people that spend below 4% of their investment accounts over a long period of time. And it's simply because their lifestyle is simple enough that they just don't need the money. They don't want the money. So the accounts just continue to grow. If it is in pre-tax accounts, yeah, it becomes an RMD problem. And it's not a problem. Again, good problems to have. It's just money that needs to be taken eventually, and taxes need to be paid. So let's just say that we have $1 million in our investment accounts, in pre-tax, Roth, and taxable investment accounts. $1 million total amongst all accounts. If we're going to draw 4 to 5%, we can draw anywhere from $40,000 to $50,000 from that account. So $40,000 to $50,000 from that account is what we're able to draw comfortably without drawing down our account. If we wanted to draw our $54,000 a year and we didn't have to worry about taxes, right? Then we need at least $1,080,000 in that account in order to draw comfortably without distributing more than our 5%. So we need a little over $1 million in order to draw our $54,000. Now, if there's taxes associated with it, we'll need more, of course, because taxes count. Taxes count as expenses. So we need to stay within 4 to 5%, including tax liabilities as well.
I think my next question would be where exactly, or I guess what's the strategy on pulling that money?
Great question. And that's really the thing that we're going to be talking about next is now that we know how much we need, and we need $54,000 after tax, where does that come from? And really what we're trying to look to do, what we're trying to accomplish here is we want to make sure that we're drawing from various accounts to manage our tax situation and to keep us below our Medicare IRMAA premiums, right? We don't want to pay additional health insurance premiums on our Medicare. And fortunately, in the situation that we're talking about, I really don't expect that'll be a problem. $212,000 is the first tier threshold for IRMAA premiums on Medicare. So we've got a wide berth on that because we're only going to be living off of about $120,000 a year. Now, for somebody who wanted to live on $240,000 a year, now we really want to get sophisticated with where do we draw it from to try to keep us under those Medicare premium thresholds. The other question comes in is what is the breakdown of the accounts that we have? How much money is in Roths? How much money is in after-tax accounts? And how much money is in pre-tax IRAs? Because that breakdown it's really important to understand that. If we don't have a lot of money in after-tax accounts, not a whole lot we can do. Not to mention the after-tax accounts are also going to have dividends and interest that will increase our taxable income, even if we're not drawing that. So we want to make sure that we're accounting for all of that. But really the first step, the first place we're going to draw money is, like I just mentioned, from our dividends and interest from our taxable investment accounts. If I have a $500,000 investment account and 4% is coming out in, I'm getting dividends and interest on 4% of that account, then I should have roughly $20,000 a year coming in dividends and interest that is taxable already. So why not take that? So the first $20,000 comes from dividends and interest from a taxable account. Then after that, we want to blend the situation, almost like a little bit like an orchestra, right? We've got different instruments that do different things, and we may want them all playing at the same time, just at different volumes and at different levels. The intensity of where we draw from which account is really going to vary. If you don't have any IRMAA problems, if you don't have the other two things to consider is Social Security. Your income tax and your Social Security, it's got its own little tax bracket that it's tough to calculate. We've built a spreadsheet so that we can run the calculations on your Social Security tax. We also have tax software in-house that does it for our people. But if we can stay below the threshold where you pay nothing on your Social Security income, no tax on your Social Security income, that's really valuable too. So for somebody who wants to live on $120,000 that's got great tax diversification in their accounts, we can pull from different sources to try to stay below the threshold so they pay no taxes on their Social Security income. Hugely valuable because that's now tax-free income. And then the last thing are your dividends and interest. Dividends and interest have a very simple tax bracket themselves, and we can actually keep your tax on your capital gains and your dividends to zero if we keep your adjusted gross income below $96,700 for married filing jointly here in 2025. So all these things we take into account and we decide which account are we going to pull from at what time. My suggestion to you is, if this is a little sophisticated and you're not quite sure where to start, pull from your pre-tax IRA to stay within your current tax bracket. So pull enough to stay within your current tax bracket all the way through that tax bracket, and then pull the rest from Roth IRAs or after-tax accounts just to blend it out. I'm not saying that's the perfect strategy, but again, not knowing your individual situation or how your individual breakdown is, that's probably the best strategy that will give you optimal situation after you're taking your dividends and interest.
It's also good to note that there's no hard and fast rules per se with distributions. And as Ryan was mentioning before, with an orchestra, someone might be playing a higher tempo song and someone might also be playing a different song. It really depends on the person, and obviously everyone's situations are different. One person may have a huge taxable account while another person might have a huge Roth account. It really depends on your comfortability level and how much money you would need to actually sustain a comfortable retirement as well.
Yeah, of course. And that's why when we do financial planning, it's individualized to the person. Very difficult to give hard and fast rules. I know there are hard and fast rules on the internet. First draw from taxable accounts, then draw from pre-tax, then draw from Roth. I don't agree with that. I don't agree that pre-tax should always come second. I think you should almost always be drawing some pre-tax accounts in years that you can without avoiding additional step-ups in various taxes and IRMAAs. It really is a great point that you want to look at your individual situation.
And what if you have your taxable account, you're saving all that money in the taxable to make a big purchase that the person next door very well isn't making that same purchase? It's something to consider. Everyone has their own specific stories and everyone has money in different accounts for a reason.
And if you don't have good tax diversification, it's not too late. Even if you are retired, we have a lot of retirees that have all their monies in a 401k basically. They have their house and they have their 401k. That's pretty much the two assets that they're going to be living off of. And that's challenging for sure for tax diversification purposes. Doesn't mean it's possible, it's just challenging. And most of the time we're encouraging people to eat the frog in the beginning, bite the bullet, whatever analogy you want to use, and do some Roth conversions in the early years of your retirement. Pay some IRMAAs, pay some higher taxes at higher tax brackets, but let's get that tax diversification in place before they hit age 73. So required minimum distribution doesn't force them into those situations, whether they like it or not. And if they don't get it done by age 73, they're going to be stuck with higher IRMAAs and higher taxes for the rest of their life. Again, whether they like it or not. Roth conversion is something that we typically look to do. Pretty important. Let's also talk about estate tie-in. If you have large pre-tax accounts and you pass away, your beneficiaries are going to have to take from those accounts over a 10-year period and pay income taxes on those. You might not be concerned about it. Again, good problem to have for your beneficiaries. I've seen people leave $1 million IRAs to their one child who is earning a good living themselves and now has to take $100,000 a year for the next 10 years and is basically paying a pretty significant tax on that because they're already in a higher tax bracket. Roth are valuable in that sense as well, because when you leave money to Roth, they still have to take the money over 10 years, but there's no tax associated with it, which is fantastic.
I've also heard clients say, what do I care? I'm dead. My money can go wherever it wants. But it's good to note that there are taxes associated with your money going places, and having those proper framings in place is really important for your beneficiaries.
I have no problem if you have that mentality that I'll be dead, what do I care? But with just some relatively simple things, we do Roth conversions really not for our beneficiaries. We do them for our clients, our members, and the beneficiaries are the ancillary beneficiary of that strategy. We're really not looking at first and foremost doing conversions for those people. Let's talk about our action steps here as we wrap up. So the first thing that we want to ask everybody to do is sit down and figure out, what are your guaranteed income sources? Where is your money coming from that you know that's guaranteed and that's coming? And figure out if it's inflation adjusted or not. Next is figure out your expenses. Remember, focus on annual expenses. That's the key. Make sure that we have annual numbers in place. Third is figure out what the gap is, right? That's the gap we need to fill, the difference between your income and your expenses. We didn't talk a lot about the gap and how do we improve it. We look to improve it here at Synergy for people. So if we can do things like use a small amount of money to pay off your house, that will massively improve your gap. If you're paying a $3,000 monthly mortgage payment, but you only have $90,000 left in your house, we can use $90,000 of your assets to free up $3,000 a month in gap is a huge change and a huge benefit for retirement cash flow. So figure out what your gap is and can you improve that gap. Next, figure out which account you want to draw from in order to ensure that you're going to be the most tax efficient. Like I said, if you need to draw $5,000 a month, you know you're getting $1,000 a month in dividends and interest. Where is the $4,000 going to come from? Try to fill up the tax bracket that you're in, and then look to draw from after-tax or Roth accounts as well to manage your tax situation.
It's really good to know exactly where you're pulling these funds just to save money on taxes. You never really want to give money to Uncle Sam if you don't have to.
Absolutely. And most people are very willing to pay their tax obligation, but they don't want to leave a tip. Thanks so much for joining us and for listening. If you enjoy what you hear and you think you're getting some good information, please make sure you're leaving us 5 stars. 5 stars is really helpful to us to spread the word. And make sure you subscribe so that every time a new podcast comes out, more and more great information about your retirement comes out, you'll be the first to know about it. Otherwise, we look forward to seeing everybody next week.
Stay intentional and happy planning.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.